As I said, this is a massive fund. As of the fiscal year that ended last March, so I'm not going to say what happened for this year, they have $340 billion of assets under management. Dilhan Pillay has overseen this fund as it has changed pretty significantly from back in 2011, primarily being an investor in Singapore assets. Today being very different. Could you just, before we get into some of the current events and what's been going on in markets, just give us a sense of that transformation that you've seen?
So actually the transformation done by my predecessor, Ho Ching, and she was brought into Temasek to make us more of a global investor. When she first came on board, 97% of our assets were Singaporean companies. And by the way, we own our assets, we don't manage it for anyone. By 2011, we had made it such as about, something like about 56%. And today, Singapore assets are just 41% of our total net asset value. And so that transformation that's been done over the last, I would say, 20 years has been predicated on investing in global markets. We first started in Asia in the first decade of the 2000s. And then in the second decade, more into the US and Europe, because we felt that a balance between developed markets and emerging markets was required. We also started to increase our allocation into funds and asset management platforms that we set up. And so today, we have a fairly balanced portfolio, which is 41% of Singapore companies that we control, roughly about $150 billion of revenue that's either consolidated with balance sheet or of companies that we control with significant minority stakes. 30% is in global investments all over the world. And the balance of 23% is in funds, asset management companies, and partnerships that we have with either financial institutions or corporates. So it's fairly balanced, I would say.
And you were speaking before, and you were saying about half of the fund is liquid, and half of the fund is illiquid in private markets.
Yeah.
As we sit here today, the world feels very dynamic.
Yeah.
We were thinking about AI disruption. Now we're thinking about an oil shock that could potentially send inflation spiraling. As someone who tries to toggle between private and public, liquid and illiquid, how do you think about catalysts that seem to be coming at us increasingly frequently?
Yeah, that's a good question. So if I were to go back to 2011, we were 80% liquid, 20% illiquid. By the end of the decade, we were sort of like 55% illiquid, 45% liquid. Today, we're about half and half. So 50% is in liquid, 50% is not liquid. If you look at this chart here, you will find that we're primarily an equities house. So you take away the private credit at 2%, core plus infrastructure at 1%, 97% is in equities. And it's 48% liquid and 49% illiquid. So it's a balanced portfolio. Now, why is it that we went into private markets? In a low interest rate environment in the past decade, you could actually argue that you could earn the illiquidity premium within a reasonable time frame. So in the previous decade, time to monetization through public markets within 5 years, it then went to 8 years. Today, you're looking at past even a decade. So the question for us today is whether you will get the illiquidity premium in a higher interest rate environment. So that's why we've decided to put a little bit more capital into liquid strategies. That includes public markets, investing indices, and things like that. Because we feel that in a world where there are more surprises, shocks coming more frequently, disruptions like AI this time around, it is important to have enough liquidity to be able to pivot, change strategies, pivot, decide where you're going to put your chips for the longer term, or even rebalance for the shorter term. And so as a result of that, we've decided that we should maintain a certain level of liquidity in our portfolio, because we do think there's a premium in being liquid today. That's our view.
So, and I want to get into just how much you are planning to continue to increase the liquid versus the illiquid part of your portfolio. I mean, is that significant in terms of how much more you have to go?
No, I think we're there. I think for now, for every dollar we invest, we're not going to do it in a programmatic way, but I think it would end up being sort of 50-50. Some years there may be a little bit more because of opportunity, some years a little bit less, but we'll make sure in the long run we maintain that balance.
We'll get into the private side of things, but before we leave this, I want to get your thoughts then on how you respond and be dynamic in the face of a potential oil shock, since that's the latest catalyst, in addition to AI disruption and credit fears, that seems to be targeting investors. Do you respond to that? Does it make you pivot?
Things like oil shocks, we've had to live with it for a long time. And parts of our portfolio will be impacted by it. For example, we own an airline. By the way, for those of you who fly regularly, please consider our airline. whenever you have something like this, what's going on in the Middle East, straight away, even though the Middle East is a small portion of the revenues, people think about the potential of increased oil prices on your P&L. People might travel less because of conflict and things like that. Every time there's something like the avian flu, your airline gets impacted by share price, so everything gets impacted if you own an airline. Look, some parts of our portfolio clearly will be impacted by rising oil prices, power generation companies which have inputs from natural gas and things like that. But the bulk of our portfolio is not. It's quite inoculated from the impact of oil prices. Obviously, for the financial services sector, it's a proxy to the broader economy, so that part of it gets impacted. But we've got a fairly balanced portfolio. I'm less concerned.
When you talk about the 50% that is in private markets, I just wonder how much, you said 2% is in private credit, how closely you're watching what has percolated out that people see potentially deepening, really the epicenter right now, BDCs, private credit funds tied to software.
Yeah. So first of all, I would say that private credit is a relatively new part of our portfolio. We've always been investing in it for the last, I would say, 20 years, but we started to ramp up about 10 years ago. So the 2% of our portfolio value, which is roughly about $7 billion US, it's really something that we built in the last 10 years. We have a separate entity, a credit hybrid solutions entity that we spun out as a wholly owned subsidiary. And that has a very clear mandate, get us something like a 5 to 6% cash yield on an annual basis, a total return of maybe low double digits, 11 to 13% with a leverage cap and a cap on PIK because we want the cash yield. And with that mandate, they've managed to do quite well. The credit quality is keeping up. Besides that, we have investments in funds with people that we believe are best in class. So far, they're holding up. So it's really a question of manager selection, the kind of the part of the credit sector that you want to put your money with, and then you have to figure out whether the asset quality is there, whether the fund managers are doing what they're doing. And so far, I'm not as concerned with our credit portfolio.
So there are two ways to ask this. First of all, it's only 2% of your portfolio, so it's pretty small. You address the one of how is your portfolio managing through this. The other way of saying this is, at what point do you get excited about where you can potentially expand and get involved if there is dislocation? So
that's always the exciting part, isn't it? Because if you can get in cheaper, that's the best way to make returns. It's all a question of the entry-level price. So when there's a lot of froth in the market, you take on more risks. It's more expensive to get the returns that you want. So the question for us, you still have to go back to the question of asset quality and the pricing for the asset quality, right? And so I think that there will be opportunities for us to partner with the funds that we are invested in to look at those opportunities at the right time. You have to, it's opportunistic, okay? It's opportunistic. And it's not going to be a major part of our portfolio. We're still going to be equities focused, right? So maybe private credit can go up to 5% of our portfolio over the long run. But we don't want to change the DNA of the firm. It's primarily equities firm. Now, why do we do private credit? Well, it's simple. It's a little bit of a diversifier from our equities exposure. It gets us up the capital stack compared to where we normally would be. But the most important thing is it gives you market signals of what could happen in the equities piece of your capital structure. So that's what we look for.
What's the signal right now?
Certain asset classes or certain sectors that we're invested in, we've got to be very careful about looking at the balance sheets of those companies and what it means in this cycle today, and whether the cash flows that we're underwriting are going to be strong enough, to withstand volatility or shocks in the system.
Shocks in the system is one thing. Disruption as a result of the new technology. So how do you identify who's prone to it, whether the software shock is really specific names that are going to go to zero and others that are going to be incredibly successful, or some kind of widespread replacement?
So I think, with what we've seen in the last few months, things that you didn't think would be disrupted are becoming disrupted, or at least the perception of disruption is very high. And so you now have to think about other things that you're investing in and what is the likelihood of disruption, because today the reality is that disruption may come sooner than you've expected before. And therefore, to what extent are companies prepared for that? Now, I would say the counterbalancing to AI disruption is AI adoption. So if you have companies that can adopt AI to accentuate their business models and be able to not just withstand the shock of disruption, but actually thrive in it. That's the most important thing that we look for. And that's what we're doing today through our portfolio.
Are there certain types of companies that seem like they are able to take advantage of this disruption versus just those that are looking to potentially survive through it?
Yeah, so look, even with software companies, right, which are in the news all the time, if you're mission critical and you know how to use it to actually accentuate your product offering, it's a good place to be in, because no matter what, we're still going to need software. It's not like AI is going to take over and the entire software sector is going to dissipate. But you've got to make sure you can pick the right companies to invest in. I think that AI is going to have a profound impact on sectors like pharma, biotech, drug discovery, drug development. I think it's going to have a profound effect. And so those companies that partner with for AI solutions are going to be a beneficiary. The question is just when. It's also a highly regulated sector, so a lot of things have to happen for you to see the full benefit of AI adoption.
So you were talking about how things are pretty dynamic, and these are things you can't know right away. And so that's one of the reasons why you want to have a bigger proportion of your portfolio in liquid versus private companies or illiquid. Can you give us a sense of which companies you'd rather own in your liquid versus illiquid? Is there a certain type of asset class or a certain type of industry?
Yeah. So look, you got to, when you look at liquid, you got to figure out which part of your portfolio is really for the longer term, and that's compounding. So you got to look for companies that you feel can be compounded. Some of the Mag 7, you can take the view you can compound for a long period of time. If they keep innovating at the pace that they're innovating. There are other companies which we feel in the deep tech sector, et cetera, that could also be compounding. You look at where the choke points are and demand versus supply, and you can figure out that some of these companies could be companies owned for 10 years in the public markets. There is going to be more convergence between AI and climate adoption, climate tech adoption. Okay, and I think that that's what's going to help with climate change transition for many of us. And I think that that's exciting for us to look at and see which companies will be prime beneficiaries of that. So there are many different sectors where you can look at it differently now because of AI.
You talk about returns, and you've delivered some pretty significant returns investing in private markets over the years. And I just wonder, you expect bigger returns for taking bigger risk. And there are times that feel like a better time to take more risk and times when maybe not so much. How do you characterize the moment we're in right now?
So I think it's probably the most trying time to be a long-term investor. It really is, because if you're trying to invest for the long term, you're trying to invest through market cycles, and nowadays with the disruptive forces out there, what exactly is the cycle for your business model? Are you continually transforming your business model for that? And I think a lot of it depends on the industry, the company, the psyche of management, and things like that. Even we as a shareholder, an investor, pushing for companies to continue to always be on the edge of transformation. And I think that is the biggest issue for us, as a long-term investor. So if I look at what concerns us as a long-term investor, or what's on the horizon for us, first of all, it's geopolitics. It does impact. Secondly, it's geoeconomics. What happens for the US dollar does impact our returns, for example. The third would be technology. Both not just in disruption, but how do you use technology to actually improve things, not just in business, but in the world. And finally, the investment strategies that take all these things into account. So, in that sense, 10 years ago, we didn't have to think so much about geopolitics. Geoeconomics are fairly stable. Technology disruption was identifiable. And then finally, your investment strategies are pretty much linear. Today, it doesn't happen that way anymore, I think.
So talking about geopolitics, do you think that people are overly sanguine right now in markets about the geopolitical risks?
I think the market has taken a view that some shocks can be shorter in duration than otherwise, and so therefore they are pricing the risk, but they feel in the longer run, you might be able to get around the risk and still be all right. I'm not smart enough to know whether that's the right thing to do or not. I'll just watch and see where we put our funds to work. But I do think that there is a certain amount of, I think the market's relatively sanguine with everything that we're seeing. And let's face it, right? I mean, since what's been happening in the Middle East, the markets really haven't moved down that much. S&P is down, 1.5, 1.6%. Our financial year is 31st of March. What happened 2nd April last year? And you saw with the way market moved down. Thankfully, our financial year is 31st of March. Or thankfully, the Liberation Day happened on 2nd April. Anyway, this time around, I've still got 27. We still got 27 days to go for our financial year to close. It's better to look out 5 months down the road because something had happened to turn it around. 27 days is interesting. So let's see. Yeah.
I want to finish up on dollar exposure because.
But can I just add something? You see, we're allowed by our shareholder, and shareholder doesn't get involved in our business at all, to take more risks because we're equities investor. So we're high on the risk. I would say on the risk curve, and our threshold for pain therefore has to be higher. And so the requirements for returns are therefore much more than what would be required for a sovereign wealth fund. So that puts you also a little bit more on edge, right? Because you have a responsibility of trying to deliver those outsized returns. And in inflation adjusted world where interest rates are higher and possibly higher for longer, we should expect to get those higher returns. So we have to put that on ourselves.
Yeah, so you notice some of the risks out there. I do want to finish up with the risk of the dollar because about half of your portfolio, I believe, is exposed to the dollar.
Directly 41%.
41%. So I'm just curious how you're hedging. Are you planning to reduce exposure to the dollar in order to avoid some of the fluctuations, or are you going to double down?
So the most trying time was the second quarter of last calendar year, when the dollar began to depreciate significantly against the Singapore dollar. And Singapore dollar is our reference currency. And in any event, 50% of our exposure is in Singapore dollars. So it moved, I think, almost 5 or 6% during that time. It's about 7% down year on year. But it went up a little bit in the last few days. So that just tells you that the dollar is truly, the currency you go into in times of risk. So what we tried to do then was we figured, okay, we'll hedge part of the dollar-denominated portfolio, which we did, a significant amount, I would say. And the cost was fair, was okay. But as we go along, everybody else had the same idea. People were not rotating out of US dollar-denominated assets, they were hedging for returns. And the hedging costs went up to, 2.5, 2.6%. So today, the cost of hedging doesn't make sense unless it's tactical for a shorter period of time. And so we now have to basically put in place what we will call natural hedges, which really means you have to invest in things that will give you a return that outpaces expected dollar depreciation. But, the events of the last few days reminds us that the US dollar is still, the global currency of choice, reserve. It's not just a reserve currency, it's a safe haven currency for many things that happen in geopolitics and what happens in the world. And so I think we've got a good balance, I would say. The dollar has strengthened. The policy of the Treasury Department is to have a strong dollar. So in that sense, would that change anything that we're doing? The answer is no. We'll continue to invest significantly in the US and US dollar denominated assets.
Well, there is so much more that I want to ask you, but unfortunately we have run out of time. Dilhan Pillay of Temasek, thank you so much for being with us.
Thank you.
Today.